Okay, hey, how are you? This is Kyra Wilder with Coldwell Banker Realty, and we are doing a hard money webinar. I know financing is one of the number one questions I get working in the industry with people buying residential or buying their first investment property. And so, hard money is one of my favorite things to tell people about because they often don't know it exists. And in order to present that to you and kind of let you know the details, we have Patrick here with Rock East Funding. Hey, Patrick, do you want to introduce yourself?
Yeah, Patrick Bertucci. I'm the business director of business development for Rock East Funding. Um, I've been in the business of real estate, finance, and as an investor for upwards of 25 years or so.
Wow. I wouldn't have guessed that long. Wow.
Yep,
Okay. So, let's get right into it. Don't want to take up too much time. So, one of the things, can you just tell us exactly what hard money is?
sure. So hard money is it's really very, very similar to a traditional mortgage. We record a mortgage just like a traditional conventional mortgage does. It is basically money that's backed by real property. Just very similar to a mortgage. What differentiates hard money from a conventional mortgage is really the way in which you can receive it by the terms that you need to meet in order to get the money. So it's a lot more lenient to get hard money than it is a conventional mortgage. And traditionally, hard money, we're going to be lending to a corporation or an LLC, whereas a conventional mortgage traditionally they're going to be lending to an individual.
Okay. So, anyone looking to start to get into this, they should get an LLC first, basically.
Yeah, they should have an established LLC or even a corporation. They could speak to their attorney, their accountant about that. But it is absolutely, imperative that they do have some kind of business entity that they're going to use to purchase the property.
Right. Okay.
Um, so it's also important that if there's more than one person qualifying, that they both need to be members of that LLC. You can't have two people qualifying for a hard money loan and only one of them as a member of the LLC.
Okay. And did you want to touch a little on why that is? Why not to an individual?
Um, I guess it's kind of it's a tough question. It's because it's a business transaction. Traditionally, real estate investment is not, you're not, we're not lending to an individual. So traditionally where they are not living in the homes.
Right. Right.
So we want to keep that distinction between the two types of loans. One, you're going to qualify personally for it. They're going to look at your personal financials for it, and you are going to live in it, and you're going to be tied to that asset.
Right.
Whereas with hard money, it's not at all like that. A business entity owns it, and we're lending directly to that business entity, so it's a business transaction.
Okay, yeah, that makes a ton of sense. And speaking of, what kind of projects are best suitable for this kind of financing?
Really any type of investment property. So you could be a single family property, it could be a duplex, it could be, really 1 to 4 family properties, it could be attached properties, detached properties. You could do multifamily, which are 5 and up units. You can do condos, townhomes, you really name it. And as long as the deal makes sense, it's not rural properties are difficult to finance. So you're
Yeah.
going to want to stay away from that. Also, properties that are that are traditionally in areas that are used just for vacationing are
Okay,
also
great.
difficult to
Yeah.
finance. You're going to want to stay where a property is going to be marketable for sale, and the asset is going to be purchased by the end user, and it's going to be in an area where, and the end user is going to want to be in that area. That's really like in a situation where you have vacation homes.
Yeah.
Oftentimes, if the economy goes bad, those are the first homes that people kind of walk away from,
Right.
and
Yeah.
they're not really sought after because it's not their number one priority.
Right. Okay.
So it's hard to find buyers for them if it's not their number one priority, be in that area. So.
Absolutely. And as in terms of, so would you say this is good for someone who's looking to do some of like a long-term investment strategy, maybe like renting, or is it better for a short-term like flips?
Well, really, the market has changed tremendously. It's really it runs the gamut. So we do a ton of fix and flips,
Yeah.
um, but we also do a lot. We're seeing more and more long-term rental investments,
Oh, really?
the rates are very attractive. They're very competitive to conventional rates, except in order to qualify for them, it's far easier to qualify on the hard money side, and you have less exposure from a legal aspect.
Right.
And then we also do, um, especially for contractors, we'll lend for construction, ground up construction funds where people are doing spec builds and then they're going to want to sell it. So
Right.
we do that as well. So those are the three types of properties. So you have or three types of loans: your rental loan, your fix and flip, and your construction.
Okay, yeah, yeah. And I know hard money for flips. I know that that's, a super popular and attractive option for that type of investment. And I know you were speaking about qualifying. So can you get into that? What does it take to qualify for this type of financing?
Well, I mean, initially, the docs that are needed or the documents that are needed for like the pre-appraisal are an application and just a description of the deal. So if you came to me and you said, I'd like to get pre-approved, or I'd like to run this deal by you to see if it's possible, we'd need an application on you, which is a very simple form. And then we would need an approximate credit score, the purchase price of the property, the renovation budget of the property, and then the after renovated value, which
Okay,
is, you're going to hear the term ARV in this industry a lot, and that's after renovated value. So those things, those five things: application, approximate credit score, purchase price, renovation budget, and ARV.
okay,
And
okay,
then we're able to give you an idea as to whether or not the deal will work.
okay,
And then we're going to look deeper into it. And if you wanted to move forward with it, then we'd need a contract of sale,
okay,
scope of work. Scope of work is a description of the construction budget.
okay,
Um, your We'd actually pull your credit report at that point, and we'd actually take a look at it and make sure there was no surprises. Copy of your driver's license, and then the corporate and LLC docs. And then we'd have an appraisal done on the property.
okay.
That's it. So there are no W-2s, there are no pay stubs, there are no tax returns. Um,
Yeah.
it's a completely different world.
Right, exactly. Okay, so yeah, and that's what I wanted to get into basically. So for someone to best prepare, they're going to need to have that scope of work and really have the numbers down so that they can prove that, this deal is really worth something. That's what you're looking for.
Yeah, well, what we're looking for is it's our risk analysis is not based. It is based on really two factors: experience and credit score are the two main factors.
Right.
So if you have a tremendous amount of experience, you've done a lot of fix and flips, but you don't have the best credit, you could still attain financing for a fix and flip.
Okay.
That said, if you have zero experience and your credit score is not great, you're going to have a difficult time attaining financing.
Right.
So and now, if you have a tremendous amount of experience and you have a great credit score, you're going to get the best possible terms that you can get. So our risk analysis is heavily weighted on the amount of experience you have. That said, if we were using an arbitrary number like a 680 credit score and above, and you were a first-time investor, there are options for you.
Okay.
Um, they're going to be, depending on the area that the property is in, whether it's urban, whether it's specific counties. Depending on the credit score, it's anywhere from 25% down to 15% down.
Okay.
Um, and it depends on the credit score and the area.
Okay. And that's
But you do have options as a first-time investor.
okay. And that's great to know because again, that is people's really just the main barrier to entry is that and not realizing that there are so many options for them. So I did want to touch on what you consider experience. Now, if someone's never invested in a property, but maybe they come from a background of construction, uh,
Mhm.
or their family is in contracting or something, does that kind of tip the scales in their favor?
Well, it they would still be if they never flipped a property, and it was again, if we're talking about flips and they never flipped a property before, their construction background unfortunately is not going to really be heavily weighted.
Okay.
We what we would call that is more of a compensating factor. That's more if you flipped one property, let's say, and you're a realtor and you're a contractor, and so so you have compensating factors as well as the fact that you did one deal, then it may be looked at more favorably. But if you have no experience at all, you'd still be considered somebody with no experience.
Right.
It would sweeten the deal a little bit, and there would be a higher comfort level, I guess.
Right. Okay. That makes a ton of sense. So, okay. And that was one of the things I wanted to go basically what you were looking for. And you really just touched on that. Let me just pull up my notes for a second. Can't remember everything. Okay. So, how can someone best prepare? How can someone make sure that, they're giving you everything, and putting their best foot forward and not just, being sloppy about it or coming to you trying to get financing? How can they best prepare themselves?
Well, I think we touched on a little bit of it already.
Yep,
First
yep,
of all, know what your credit looks like.
yep,
Uh, have an idea if there's something wrong, um, because the difference between 660 and 680, or in that range, or 660 and 700, those are very easily changed. uh, a lot of times,
right.
the difference between those two numbers can be easily changed by doing small things with your credit. It may be paying off a credit card or something like that. And then some people, they don't know that they have big problems. So
Yeah,
find out, right? They may have tax warrants or things like that,
yeah,
that they're not even aware of. So find out what your credit looks like. I would, there's so many sources that you can use now without doing a hard pull on your credit. Most of them come from credit cards. Um, so make sure you find out your credit worthiness. And then the next thing you could do is you can prepare by having the corporation or the LLC set up,
mhm,
having the appropriate members that are supposed to be in it. So, for instance, if one member had zero experience and
mhm,
they wanted to take on a partner so they could get better or more favorable terms,
yeah,
do that ahead of time. Make sure that the members are all set up and in the corporation, and things are ready to go.
yeah,
Is the other thing is have your team prepared. If you want to do this, it's so important, just like any business, to have a team. Who's your real estate attorney? Who's your realtor? Um, Make sure that the people that are who's your contractor,
yeah.
are they licensed? Does that matter to you? Does it not? It's all these things are super important to have in place beforehand if you can, because you don't want to scramble around trying to make it happen after you get the money and you're paying interest on it.
Yeah, exactly. Very expensive time to be scrambling.
Right. Right.
And so we do know that when it comes to hard money, one of the things I love, and that some people, when I was speaking to my dad, he invests in Michigan where he lives. He didn't know that there were loans that would help you with renovation costs. And so, how does that work in this term with the renovation funds that you provide people, and how is that distributed throughout the project timeline?
All right. So, all the way across the board on the fix and flip products, regardless of credit worthiness or credit score, I should say, um, you're going to get 100% of the construction funds. You're
Ooh,
going to receive 100% of construction funds.
yeah,
So that's always a good thing. And I know it didn't always exist, but it is true now.
oh, I
Um,
didn't know that.
and so, and the way they're distributed is it's specific to your scope of work. So the scope of work being completed properly by your contractor is super important, because I can't, I'd say it's one of the number one pitfalls that we see, is that people, they'll give us a budget, they'll give us a scope of work, you know, they'll have gone through it with their contractor. There'll be loose numbers. There'll be a lot of things that were forgotten.
Yeah.
And they had no contingencies in there built in. And they start working on the project, and they are finding that they're going to run out of money at the end, and they didn't include everything they needed to in the budget, and then they have to take money out of their own pocket. So that's one of the major pitfalls when it comes to construction funds. Now, the way it works is after you get the loan, you're actually going to start doing the construction with your own funds initially.
Okay.
So you may do the demo, you may do the rough electrical, and you may do the rough plumbing. And then you may say, Pat, I'm ready for an inspection to be done on the property. And then we go in and we say, all right, we look at your scope of work, we check the things off that you've done on the scope of work, and we distribute you back the funds based on that scope of work.
Okay.
Does that make sense?
Yeah, it does. And then so throughout, are there draws after you finish that initial inspection and doing the initial work?
So that would be considered the first draw.
Okay.
All right. And the reason why we do it this way is because a lot of people say, wait a second, you know, and the reason why I touched on it is because they say, well, I thought we were going to I thought you were giving us 100% of the construction funds. I thought you were just going to give us
Yeah.
100% of the, right. And the issue with that is it's not, you know, with our, you know, we're fortunate to have very strong relationships with our borrowers. 90% of the people that we lend to come back. I can't say that's true for everybody. It is true for us. And we have a comfort level there that's built in after a while. But when you're first lending to somebody, you don't want to just hand them $50,000 and hope that they use that money to improve the property.
Right.
So, you know, we have to make sure that the property is actually being improved, and then we give the money back. And that's how it works. You need to, you know, there's got to be a little bit of a give and take, especially initially in the beginning of any relationship. So expect that as a new investor. Don't be surprised by that. It's the way it works.
Okay. Yeah, that makes a ton of sense. You know, in no other situation would you give someone that amount of money. So it shouldn't really be expected here.
Yeah,
Okay.
I mean, we don't mind doing it. It's what we're there for. It's just, and it's traditionally it's not $50,000 draws, you know. So let's say it's a $15,000 draw, but that initial draw, you just want to make sure, and you want to be a partner in the business with the people that you're lending to, and you want to give them the guidance that they may need, like, you know, all right, you're doing this, let's take a look at your scope of work. What makes the most sense for you to do next time? What makes the most sense for your next draw if they're newer in the business? And we can give them a little bit of guidance.
Yeah, that's great. And it's definitely much needed.
Mhm.
Aside, people think the finances are the craziest part, but when you get in it, there's so many different things that can happen if you're not prepared. So it's excellent to be able to know that your lender is your partner as well, which is
Yeah.
great. And I just wanted to know as well, what questions, we know that predatory lending is a thing. We know that some people or lenders are not, as great as you guys. So what can people ask? What should they look for when they're trying to choose someone to go with? Even though you should go with Rockies.
I appreciate that. I would say that uh, the first thing is when you go to close, nothing is set in stone until you're at that table and you're signing those documents.
Yeah,
So
yeah,
yes, it's super important to know what's happening, but never, you know, you should never, if you feel uncomfortable about what you see when you get there, because your lender is, you know, you have to be prepared for that fact. You have to make sure you have a good partner in a real estate attorney that is there to protect you. So the things that you're going to want to ask are, what are your fees? Obviously, you want to know how much you're paying for the service that we're providing. So what are your fees? Do you have a processing fee? Do you have an underwriting fee? Do you charge interest on the entire amount of the construction budget? So for instance, with us, you only pay interest on the money that has been used. So if you have a $50,000 construction budget on a property, and you know, at that day of closing, and you haven't started working on the property yet, and you haven't taken a draw yet, you're only paying on the principal amount of the loan that was given to purchase for the acquisition of the property.
okay, yeah,
So then once you get your first draw, then you'll pay interest only on that first draw. Say it was $10,000. The other $40,000 in this case, you will not be paying interest on, and that's with us. So find out about that, because it could make a difference long term in the investment. As far as what else you can ask, you could find out. Like, we're very proud of our reputation, and we have some people that are just have been with us for 20 years. So, you could do a little bit of research too, do a little bit of digging. You can ask a local attorney that is really savvy, that knows about hard money lending, who's a good lender too. Don't just go to anybody, get a referral from
Yeah,
somebody.
absolutely. And that's one thing too that I always tell people, there are options. You don't have to go with the first person that you see. You should definitely be interviewing, just as you're being interviewed for, loans and things like that. You should make sure you know who you're going with and trust who you're going with. Um,
Absolutely.
so yeah, that pretty much wraps up a lot of questions that I get asked when I try to explain this to people. So do you have any finishing thoughts or any words that you want to impart onto people?
Um, I would just say that the do your due diligence. Make sure that you're careful in your approach. Take your time. Um, don't overbid if your gut tells you not to. You know, do what you're comfortable with. Because as soon as you get outside of your comfort zone, even when you start flipping, don't do your first flip on as a 400,000 on a $400,000 property,
Yeah,
and then do your second flip on a $1.5 million property.
right,
Um,
right. That's a jump.
yeah, it's a jump. Take a little bit of time, learn the craft. It is something to learn.
Absolutely.
Enjoy the ride. It's a great business, but really, that would be something that's really, I could say, it is important for people to do.
Okay. Well, thank you so much, Patrick. I'm going to have a link where you can actually go and fill out the application that Pat was talking about earlier so that you can pre qualify if you already do have something that you were thinking of. And also, where do you finance? What states can people
We're actually in 45 states. If you go to rockiesfunding.com, we can finance in 45 states. Right now are the
who are the
primary.
five oddballs?
What's that?
Who are
You
the
know what?
five?
They're on the oddballs are so odd that they're on the website. You'd have to go to rockiesfunding.com and say, where do we lend? And it'll point out where we lend. But the core of our business is New York, New Jersey, Connecticut, and we do some Florida. But in this general vicinity.
Okay, perfect. Well, thank you again so much, Patrick. It's been a pleasure. You guys heard it here, right from hard money lenders themselves, everything you need to know. And if you ever have any more questions, feel free to reach out to Rocky's Funding or me as well, and we'll be happy to help you. So we'll see you next time. Have a good one. Bye bye.